we're going to all pay the price for this in 1 or 2 or 3 years. This is the next time we have problems in the economy, which will be not too long. We don't have any bullets left. We've shot everything we have to solve our problems. What are they going to do? Quadruple the debt again? Print more money? We don't have any trees left.
Sitting down with economist and author Max Wolf. Max, thank you very much for sitting down with us today.
My pleasure. Thank you for having me.
Some are saying that another economic tsunami is just around the corner. Would you agree with this?
We will definitely have another serious leg down in the U.S. and global economy, although it doesn't take a lot of wisdom to say that, because that's always true. The question is when. We've done a lot of things that are dangerous, so we could have it quite soon. And the bottom line is we haven't fixed, anyone in the United States nor around the world haven't fixed the basic problems that created the great downturn of 2007-2008. Therefore, we have those problems still, but we have done absolutely nothing to basically change the root causes of those problems in the economy, which means we are living on borrowed time.
So what are the root causes of the problems?
Well, the root causes in the United States are that for 35 years, the average American's wages has gone absolutely nowhere. They've been flat. Americans have continued to have a better and better material standard of living by working more hours, taking less vacations, and borrowing like there was no tomorrow. And the problem we have now is they cannot borrow that much again. And if Americans don't borrow and their wages don't go up, and they're not significantly going up, then Americans have to buy a lot less of the world's goods. This becomes a problem because 70% of the U.S. GDP is private consumption, and America is 22% of the world. That basically means 15% of the economic activity on this earth is American private consumption. If that turns down, which it has, and if it stays down, which it likely will, this means we've basically pushed down the level of economic activity for all 6.2 billion people on Earth.
Those who cannot remember the past are condemned to repeat it. David Walker's the Comptroller General of the United States, the head of a nonpartisan government accountability office, and he says that's a warning that's worth heeding. In a recent speech reported in the Financial Times, Walker says the United States could face the same fate as the Roman Empire if we don't change our ways, and soon. Walker says the U.S. is on a, quote, burning platform. Our overstretched military, growing debt, underfunded health care, and lack of immigration policy could all contribute to our downfall unless we summon the national will to act. We've known about and ignored most of this stuff for years. It's just that now, according to Walker, the window in which to fix these things is beginning to close.
The future will be a total disaster with the collapse of our capitalistic system as we know it today, wars, massive government debt defaults, and the impoverishment of large segments of Western society. That's according to our guest today, Mark Faber. He's the editor of the Gloom, Boom, and Doom Report. So there's the gloom and the doom.
Yes.
Mark,
Yes.
What are you so concerned about?
Government debt is rising everywhere. We have stimulus packages. We have central banks that basically will print money, not just here in the United States. They have no other option than to keep the system going. And so this will be negative for the Western world compared to emerging economies.
It's going to be the trigger.
Well,
you're talking about economic Armageddon here.
Yes, absolutely. That I'm convinced. And that is, I mean, a high confidence prediction that the total collapse will come. And I'll explain how. The fiscal deficit of around $2 trillion will add, of course, to government debt. It will be in future very difficult for the Federal Reserve to increase short-term rates because then the interest payments on the debt go up substantially.
What is it like when capitalism collapses? What happens?
Well, when it collapses, essentially you have a currency reform, that old money is then called back and you issue new money.
So the dollars
So we're going to get new dollars. And it's going to be
probably
Zimbabwe.
at some...
When?
Well, I think for the next crisis, which may happen in 3 years or in 5 years or in 10 years. But one thing I want to stress, this crisis, nothing has been solved. That should be clear. The private sector, which is trying to deleverage, is offset by the government that is leveraging up. In other words, you don't reduce debts, you just essentially pile up on more debts, even more debts. And the problems haven't been solved, but they've been postponed.
back with Damon Vickers, Chief Investment Officer, 9 Points Capital Partners, staying with us live out of Seattle, Washington. Damon, you guys are a hedge fund, and what you guys basically do is you try and catch breaks either to the up or downside. Apparently with oil, also with gold, you've done the timing pretty right.
Currencies look weaker, all for the reasons that we talked about before. I mean, you've got huge wage disparities. I don't know how that inevitably resolves itself. It may resolve itself in some type of a global currency crisis. And then if the global currency crisis unfolds, then inevitably you get, I guess, an alignment under a global world government, a new global currency, and a new world order. So we may be moving towards that.
Talk to us a little bit more about this currency crisis you see erupting. What does that assume about what's going to happen to the dollar?
Well, it assumes that the dollar will utterly get destroyed and become virtually worthless. You know, we have a combined, well, I mean, here's what we know. We know that if you can produce something, that this game that we have going on in the United States and on a planetary basis cannot perpetuate itself forever. We've got a $65 trillion negative net worth. We cannot possibly meet with our health care costs and our indulgent society, which we have in the United States. We can't put that against the unit labor cost of a China that can produce something at $1 an hour versus $24 an hour with health benefits and all that's built into there. So how does that inevitably resolve itself? They export real things, and the United States exports promises and pretty paper.
Panic of 2008, you were spot on in the panic of 2008. You talk about the crash of 2010. What's that about?
Well, all this bailout and stimulus is going to be running out. We had the cash for clunkers. We've had all this real estate boost with the tax credits. We've had the stimulus. We had TARP. The money chain's running out. It's global, by the way. $5.5 trillion worth of money has been dumped into the system to pump it up after the market collapsed in March of 2009.
So after that money's spent, you think we're going to go right back to where we were?
Going back to where we were, and worse, because now you have all this debt piled on top of it. You can't print phantom money out of thin air, backed by nothing and producing practically nothing without destroying
you pay for it with inflation.
Exactly.
So how much
or
inflation
devaluation. Maybe devaluation.
The same thing. It has the same effect on the currency. It means we are going to be, the money we have in our pocket will buy a lot less.
You got it.
So how much less? How about, are you talking hyperinflation, 1,000% a year?
Maybe start at 40% less.
40%.
That's what we're looking.
Well, what is that going to lead to in our society?
The greatest depression that's coming along the line. Go back to the Great Depression. I'll tell you why it's worse. Back then, the government had trade surpluses. We had balanced trade. We didn't have negative. We were in the positive. The consumer wasn't $14 trillion worth of debt. It's a whole different story. And back then, when we got out of the Depression, what got us out? World War II, a manufacturing capacity. We don't have that anymore.
Productivity